It is 6:14 on a Thursday morning in a quiet neighborhood outside of Charlotte, North Carolina, and Harold is sitting at his kitchen counter with a single sheet of paper turned sideways under the overhead light. The paper is a Medicare premium notice, and the number printed near the bottom reads $4,956.80 for the upcoming year. He has read it 3 times already, each time slower than the last, as though the ink might rearrange itself into something more reasonable. The January air coming through the window above the sink carries a chill that he barely registers because his attention is locked on a second number, 2 lines above the first, labeled Income-Related Monthly Adjustment Amount. That number is $244.60, and it was not there last year. His fingers rest flat against the edge of the counter, not quite pressing down, not quite pulling away. He stares at the notice the way a person stares at a traffic ticket they know they cannot contest, searching for an explanation that does not arrive. His wife is still asleep, and the house is quiet enough to hear the refrigerator hum, which makes the silence around that number feel even heavier. The question forming in his mind is not complicated, but it has no easy answer. Why did his Medicare premium nearly double when nothing about his health changed at all? Harold is not careless with money, and he is not alone in this situation. Every year, a significant number of retirees open a similar notice and feel the same disorientation, because the mechanism that caused it has a name most people never hear until the damage is already done. That name is IRMAA, and it operates on a 2-year delay that makes it almost invisible until the bill arrives. 3 letters on a government form changed his entire monthly budget. The surcharge was not a penalty for doing something wrong. It was a consequence of doing something common without understanding how Medicare measures your income. And that distinction is exactly what this video is about. By the end of what you are about to hear, you will understand how IRMAA thresholds work and why crossing them by even a single dollar triggers a premium increase that lasts an entire year. You will see the exact income lines where each surcharge tier begins and how your tax return from 2 years ago is the document Medicare uses to decide your premium today. You will learn how to map your retirement withdrawals so that you stay below each threshold on purpose rather than by accident. And you will have a clear sequence of steps you can take before your next tax year closes to protect yourself from paying thousands more than necessary. You do not need a finance degree to follow this. You just need to stay focused and let each piece build on the one before it. Retirement changes the way money moves through your life in a way that working years never prepared you for. When you had a paycheck, your employer withheld taxes, your contributions went into your accounts automatically, and the IRS got its share before you ever saw the deposit. Now every dollar you touch is a decision, and each decision has consequences that ripple into places you might not expect, including your Medicare premium, your Social Security taxation, and your future required minimum distributions. If you have recently retired or you are within a few years of retiring, this applies directly to the account sitting in your name right now. Your retirement income comes from 3 general types of accounts, and the IRS treats each one differently, which means the order and timing of your withdrawals matters far more than most people realize. Think of your retirement income like a recipe you are assembling in a kitchen. The ingredients are your different accounts, pre-tax, after-tax, and tax-free. And the proportions you use determine the final flavor of your tax bill each year. Get the recipe wrong and the dish comes out bitter, not because the ingredients were bad, but because you combined them without tasting as you went. That recipe metaphor is going to stay with us through this entire conversation, because every withdrawal decision you make is another ingredient going into the bowl. Your traditional IRA and your traditional 401k are funded with pre-tax dollars, which means you got a tax deduction when you put money in. But every dollar you pull out in retirement counts as ordinary income on your federal return. The IRS treats those withdrawals exactly like a paycheck. They add to your adjusted gross income line by line, pushing you higher through the tax brackets with each distribution. If you withdraw $60,000 from your traditional IRA in a single year, that $60,000 sits on top of whatever Social Security income you received, and the combined total determines your tax bracket. There is no special discount for being retired. The IRS does not care whether the money came from decades of savings or from last month's work. Income is income on your 1040. Your Roth IRA and Roth 401k work in the opposite direction. You funded them with after-tax dollars, meaning you already paid income tax on every contribution before it went in, and in return, qualified withdrawals come out completely tax-free and do not appear on your tax return at all. This means a Roth withdrawal does not push you into a higher tax bracket, does not count toward the income thresholds that trigger IRMAA surcharges, and does not affect how much of your Social Security becomes taxable. The contrast with traditional accounts is not subtle. It is enormous, and it becomes more important every single year you spend in retirement. Understanding this difference is the foundation of every strategy you will hear in the next few minutes. Your taxable brokerage account is the third ingredient in the recipe. When you sell investments in a brokerage account, you pay capital gains tax on the profit, and the rate depends on how long you held the asset. Short-term gains are taxed as ordinary income, while long-term gains held over a year get a preferential rate of 0, 15, or 20%, depending on your total income. This account gives you flexibility because you control the timing and size of each sale, but the gains still count toward your modified adjusted gross income, which is the number Medicare uses to calculate IRMAA. Most retirees assume that once they stop working, their tax situation simplifies. The intuition feels right. No paycheck, no employer, no W-2, so taxes should be smaller and less complicated. That assumption is comfortable and logical, and it is also the reason so many people walk straight into an IRMAA surcharge without seeing it coming. The truth is that retirement taxes are more complex than working taxes, because every withdrawal decision you make now has 3 or 4 downstream effects that did not exist when your income came from a single source. Here is the first consequence that catches people off guard. If your modified adjusted gross income plus tax-exempt interest crosses $103,000 as a single filer or $206,000 as a married couple filing jointly, Medicare adds a surcharge to your Part B and Part D premiums that lasts for the entire following year. The jump is not gradual, it is a cliff. You can be $1 below the threshold and pay the standard Part B premium of $185 per month, or $1 above it and suddenly owe $259.40 per month, which is an increase of almost $74.40 every single month for 12 straight months. Over a full year, that single dollar of excess income costs you $892.80 in additional premiums. And that is just the first IRMAA tier. There are 5 tiers above the baseline, and the highest one pushes your Part B premium past $594 per month. The second hidden consequence is that Medicare uses your tax return from 2 years prior, not the current year, to set your premium. This is the 2-year look-back that makes IRMAA so disorienting. If you made a large withdrawal from your traditional IRA in 2024, you will not see the premium increase until your 2026 Medicare notice arrives, which means the financial pain is separated from the decision that caused it by 24 months of living your life. By the time Harold opened that notice in January, the withdrawal that triggered it was already 2 tax seasons behind him, buried in a return he had almost forgotten filing. Picture your own most recent withdrawal from a traditional account and ask yourself whether you checked how it affected your modified adjusted gross income. Most retirees never do until the surcharge appears. And then there is Social Security taxation, which layers on top of everything else. If your combined income, which the IRS defines as your adjusted gross income plus non-taxable interest, plus half of your Social Security benefit, exceeds $44,000 for a married couple, up to 85% of your Social Security becomes taxable as ordinary income. That means the very income source most retirees think of as their safety net is quietly being taxed at their marginal rate, and the withdrawals from their traditional accounts are the ingredient that pushed them over the threshold in the first place. Run the numbers on your own last year's return and check whether your traditional IRA withdrawals pushed your combined income past that $44,000 line. You may find that this cascade has already started in your own finances. The recipe gets bitter fast when you add too much of one ingredient without balancing it with the others. Harold's withdrawal of $48,200 from his traditional 401k rollover IRA in that single calendar year did not just raise his tax bill. Combined with his and his wife's Social Security benefits, it pushed their modified adjusted gross income past the first IRMAA threshold by roughly $3,100, and it pushed 85% of their Social Security into taxable territory simultaneously. The dominoes keep falling. One withdrawal decision created 3 separate financial consequences that will echo through the next several years of Harold's retirement. The real cost of these overlapping penalties is not what happens in a single year. It is what happens when the same pattern repeats for 15 or 20 years of retirement. If a married couple pays an extra $893 per year in IRMAA surcharges, an extra $2,400 per year in Social Security taxes, and an extra $1,100 per year in higher marginal tax on their withdrawals, that total of roughly $4,393 per year compounds into more than $65,800 over 15 years, and the math only gets worse if they drift into a second IRMAA tier. That is real money disappearing into tax inefficiency that could have been avoided with a different withdrawal sequence. There is a window in most retirees' lives that financial planners sometimes call the golden window, and it sits between the year you retire and the year your required minimum distributions begin at age 73. During this window, your income is often lower than it has been in decades because you have stopped earning a paycheck, but the IRS has not yet forced you to pull money from your traditional accounts. The lower tax brackets, the 12% bracket, the 22% bracket, are sitting wide open with unused room, like empty shelves in a pantry waiting to be filled. Most retirees do nothing during this period because they do not need the income, and that instinct to leave the money alone feels responsible. But doing nothing means letting the cheapest tax brackets go unfilled year after year, while the balance in your traditional accounts continues to grow, guaranteeing that your RMDs at 73 will be larger, your tax brackets will be higher, and your IRMAA exposure will be worse. The counterintuitive strategy is to voluntarily convert traditional IRA dollars into a Roth IRA during those low-income years, paying tax now at 12 or 22%, instead of waiting to be forced out at 24 or 32% when RMDs begin. Each conversion fills the empty space in your lower tax brackets on purpose, reduces the future balance in your traditional accounts, and moves those dollars into a Roth where they will never be taxed again and never count toward IRMAA. The math on this is not theoretical. It is arithmetic that you can run on your own return with a pencil and a current bracket table. You are paying a known, smaller tax bill today to eliminate an unknown, larger one tomorrow. When you convert a dollar from a traditional IRA to a Roth IRA, that dollar shows up as ordinary income on your return for the year of conversion, and you pay tax on it at your marginal rate. But once it lands in the Roth, it grows tax-free, comes out tax-free, has no required minimum distributions during your lifetime, and does not count toward the IRMAA calculation or Social Security taxation thresholds. Over 10 or 15 years, a dollar that was going to be taxed at 24% and trigger an IRMAA surcharge instead sits in a Roth, growing quietly, contributing nothing to your modified adjusted gross income ever again. The insight that ties all of this together is simple. Retirement tax planning is not about paying less tax this year. It is about paying less tax across every year of your retirement, and the only way to do that is to control which ingredient goes into the recipe and when. Paying a little now to avoid paying a lot later is the oldest wisdom in financial planning. The difference is that most people never see the recipe clearly enough to know which ingredient to reach for first. Meet Patricia, 64 years old, recently retired from a school district administrative role in the suburbs of Columbus, Ohio. She has $610,000 in a traditional 403B rolled into a traditional IRA, $47,300 in a Roth IRA she started late, $112,000 in a taxable brokerage account, and she and her husband together receive $3,840 per month in Social Security, which totals $46,080 per year. Their annual living expenses run about $71,500, leaving a gap of roughly $25,420 that she needs to fill from her investment accounts each year. Patricia does what feels natural. She withdraws the full $25,420 from her traditional IRA because it is the largest account and she wants to keep things simple. That withdrawal, added to her $46,080 in Social Security, brings her combined income well past the threshold where 85% of her Social Security becomes taxable, and her modified adjusted gross income lands at $69,740, which for a married couple filing jointly keeps her just below the first IRMAA tier this year, but leaves her almost no room for any unexpected income, capital gain, or required minimum distribution in the future. She pays federal tax of roughly $5,870 on the year and feels like she managed things reasonably. Your situation might be closer to Patricia's than you think, and if you have been pulling everything from one account because it seems simpler, you are not alone. But that simplicity has a price that adds up quietly over a decade. Now meet Kenneth, also 64, recently retired from a regional logistics company outside of Richmond, Virginia. He has $585,000 in a traditional 401k rollover IRA, $83,600 in a Roth IRA, $98,000 in a taxable brokerage account, and he and his wife receive $3,720 per month in Social Security, totaling $44,640 per year. Their annual expenses are $70,200, leaving a gap of $25,560 to fill. Kenneth takes a different approach because he understands that the recipe requires balance between ingredients. He withdraws $9,200 from his taxable brokerage account, realizing long-term capital gains of approximately $2,400 that qualify for the 0% rate given his income level. He then pulls $8,800 from his Roth IRA, which adds 0 to his taxable income and 0 to his modified adjusted gross income. Finally, he takes just $7,560 from his traditional IRA, bringing his total withdrawals to $25,560. His combined income stays well below the IRMAA threshold. Only about 40% of his Social Security is taxed, and his federal tax bill lands at approximately $3,190, nearly $2,680 less than Patricia paid on almost the same withdrawal amount. That difference is not a rounding error. It is a deliberate result of choosing which accounts to draw from and in what proportion. Kenneth then adds one more layer to his strategy. He converts an additional $18,400 from his traditional IRA to his Roth IRA, filling the remaining space in the 12% tax bracket up to the top of that bracket without crossing into the 22% zone. The conversion costs him roughly $2,208 in additional federal tax this year, but it moves $18,400 permanently out of the account that will generate required minimum distributions at 73 and into an account that will never be counted toward IRMAA or Social Security taxation again. The math behind this decision is what separates a reactive retirement from a strategic one. If your income is unusually low this year because you just retired or because you had a gap between your last paycheck and your Social Security start date, this is your window, and it closes a little more with each year that passes. Over 15 years, the cumulative difference between Patricia's approach and Kenneth's approach is staggering. Kenneth's annual tax savings of roughly $2,680, combined with the compounding benefit of the Roth conversions he executes each year, add up to an estimated $58,700 in total tax reduction over that period, and his IRMAA exposure drops to 0 in every single one of those years. One recipe fed two people, but the proportions made all the difference. The first thing to do is pull your most recent Social Security statement and your most recent tax return, set them side by side, and find three numbers: your adjusted gross income on line 11 of your 1040, your total Social Security benefits on line 6A, and your modified adjusted gross income. These three numbers are the starting ingredients for your own recipe, and you cannot plan a single withdrawal until you know where you stand today. The second step is to map every source of income you expect for the current tax year. Write down your Social Security benefit, any pension, any part-time income, any rental income, and any required minimum distribution if you are 73 or older. Add them up and compare the total against your annual expenses. The gap between what you receive automatically and what you need to spend is the space you get to fill strategically, and the size of that gap determines how much flexibility you have in choosing which accounts to pull from. The third step is to fill that gap using a deliberate sequence. Start with your taxable brokerage account if you have long-term gains that qualify for the 0% capital gains rate. Then move to your Roth IRA for any remaining need, and use your traditional IRA only for the portion that keeps your total income safely below the IRMAA threshold and the Social Security taxation cliff. If there is still unused room in your 12% or 22% bracket after you have covered your expenses, consider a Roth conversion to fill that space before the calendar year ends. The fourth step is to do this review every year before December, not after. IRMAA thresholds can shift, tax brackets get adjusted for inflation, and your own circumstances change from year to year in ways that demand a fresh calculation each time. Before this year ends, you owe it to yourself to sit down with a CPA or a fee-only financial planner who understands retirement tax sequencing and walk through these numbers together. A single planning session can save you more than a decade of overpaying. This is not something you want to guess at, because the 2-year look back means any mistake you make today will not show up on your Medicare notice until 24 months from now. Harold never got that planning session before his withdrawal. He pulled $48,200 from his traditional IRA in a single month because a home repair estimate came in higher than expected, and he did what most people would do. He went to the largest account and took what he needed. 2 years later, he opened a Medicare notice with a surcharge he did not anticipate. A tax bill inflated by Social Security income he did not realize had become taxable, and a growing awareness that the recipe he had been following was missing half its instructions. What Harold represents is not failure. It is the gap between good intentions and informed strategy, and that gap can be closed. The recipe for a well-seasoned retirement is not about finding a secret ingredient that nobody else knows about. It is about understanding that you already have every ingredient you need. Your traditional accounts, your Roth accounts, your taxable accounts, your Social Security, and that the proportion and sequence in which you use them determines whether the final result nourishes your retirement or slowly drains it. The most important meal you will ever prepare is the one you serve yourself across 20 or 30 years of not working, and every year you get a fresh chance to adjust the seasoning. Drop a comment below with the age you plan to retire or the age you already did, and whether you have ever checked your modified adjusted gross income against the IRMAA thresholds. That one number might be the most important ingredient you have never measured. If this changed how you think about your next withdrawal, leave a like so this reaches someone else who is sitting at a kitchen counter right now, staring at a number they did not expect.